With that, we hand it over to Sumera. Sumera.
Mangalam, thanks very much for that. Himanshu Srivastava of Morningstar Investment India joins in to answer all our mutual fund queries this afternoon. Hi, Himanshu. Good to see you in after a long time.
Same here.
You've been busy, but let's get straight down to work then. Our first caller is through to us. Amit Rathore is on the line with us from Bengaluru. Hi, Amit. Good afternoon. How can we help you?
Hey, hi, Sumera and Himanshu.
Hi.
Thank you for taking up my query in the show. So I actually, I just wanted to understand, that I tried to construct a portfolio by watching your show only. So it has helped me a lot. So I just wanted to understand whether I'm, going in the right direction, or do I need to make any changes in my portfolio to meet all my goals?
Right. Go ahead, Amit. So tell us about your portfolio.
Yeah. So I have invested, in 5 different mutual funds, which are all direct mutual funds. So I think the name of the funds and the exact amount I have mentioned in my query.
Yeah.
So yeah. So I have actually aligned them to specific goals. So just want to know whether the kind of investment that I'm doing for the time period, would I be able to meet my goals, or do I need to make any changes in my portfolio, or should I just go with it?
Okay. Well, Amit, I have to admit that when I went through your query, I was wondering if we have answered your query before, because it sounded so familiar. But now it all makes sense, because it's probably the advice that, we've heard over the last weeks and months. But Amit, thanks very much for calling in and, for actually being a viewer who has benefited from this show, because that's been our endeavor all along. Himanshu, in terms of his question, he has a lot of tick marks, okay? So he has been doing SIPs. Yeah. He has clearly marked them to his goals. He has long-term plans. He has allocated an exact goal that he wants to achieve. He has an emergency fund. He's been doing his tax saving. All in all, pretty good. The only thing that that strikes me is that he has taken a very linear approach to investing, like one fund, one goal, one amount. There is a case to be made for this kind of a linear plan as well. Is that the best plan? And are there any sort of changes that he requires to make?
So obviously a very thoughtful plan. I think a lot of thought has been given into it, and a lot of things have been taken into consideration. But yeah, there are certain things that one has to take care of while investing. One of the things is it's a very, very equity-focused portfolio. So I think there is a case for diversifying the portfolio into fixed income as well. So around 25 to 30% of debt allocation or fixed income funds can be a part of the portfolio. Depending on the risk appetite, this allocation can come down and equity may go up slightly, but I don't see too much of a difference to be made there. On the market segment wise, it's a very, very balanced portfolio. Large caps are accounting for around 65% of the portfolio, and mid and small caps are around 35% of the portfolio. An ideal situation, again, depending on the risk appetite and the investment horizon that he has, I think he can increase more into mid and small caps. Okay. They can add more value over the long term in terms of generating wealth. Large caps has to be the major portion of the portfolio, around 60%. They have to be there to provide stability. Now, coming to your point, a very linear approach. I think if he's looking at each and every fund aligned to a goal, then each and every fund should be looked from a portfolio perspective.
Yes.
Right. So there is a case of adding more diversification to those portfolios which are aligned to individual goals, right? So he can add more funds across the categories, and based on that, he can approach towards fulfilling his goals. The amount that he has said and the amount that he is investing are in line with, and if he continues to do that, he will approach his goals. But obviously, there is more diversification required to reduce manager-specific as well as fund-specific risk. He has another query about whether he should shift his assets from Aditya Birla Sun Life Tax Relief 96 to Mirai. There's no need to shift. What he can add is he can add another tax-saving fund to his tax-saving portfolio. So he can add Mirai to the portfolio rather than shifting from Birla Sun Life Tax Relief. Okay. So I think if he makes these tweaks, he's on right track.
Okay, so Amit, I hope you understood this point that Himanshu was trying to make, that, since you have linked every SIP to an individual goal, you need to treat that not as a scheme, but as a portfolio, and therefore each goal may require some more diversification at that level.
So, Sumera, I have a quick question here.
Go ahead.
Yeah, see, because I got your point, okay, but if I have, 2 or 3 funds for one particular goal, then in that case, my portfolio will be very large, right? And it will be very difficult to kind of, monitor it and follow, So that's...
Yeah, I totally take your point, because in that case, then I guess you'll have to look at the overall portfolio servicing different goals at various time points, right?
So what you have to do is you have to consider each and every portfolio separately and look at that individually, that whether that portfolio is aligned enough to meet your financial goals. So when you replicate or when you separate these portfolios, you are looking at different portfolios at different point in time. So that will make the work easier. Obviously, over diversification is something that everyone should avoid. It may not add too much of a value, but at the same time, there's some diversification which is required to reduce the overall risk, which may be aligned to one fund or a one manager style kind of a risk. So to avoid that, there is certain degree of diversification that is required. So consider each and every fund as a portfolio, add diversification to it, and look at these portfolios separately, and that will help you keeping a track of your investments.
Okay, the other thing, Himanshu, that you mentioned that Amit needs to do is have a debt portion, right? And you've seen bond yields, the benchmark bond yields have crashed now to below 6.5%. I think today, it's at 6.3%. What does this do for a person's debt strategy? And for somebody like Amit, who's just getting started, I mean, he has yet to choose a debt fund. How does he go about it?
So I think debt portion is a very important part when you look at a complete holistic view of a portfolio allocation. Debt provides a stability during market downturns. That stability is very much required because it provides a cushion to the downfall that the equity-oriented portfolio can witness. Now, yields are down, but at the same time, you need to understand that bonds are delivering better returns over a period of time, right? You can expect around 7 to 8% returns, say, over a 3 or 5 year period. Now, I'm not saying that bond, typically what investors think and take into account is for a short-term period. Actually, bonds are not really for a short-term period. Bonds are one of those, or debt funds are one of those instruments which will be in your portfolio for the longest period of time. Because there is a certain time when you can't invest in equities, but fixed income will definitely be a part of your portfolio. So from a holistic point of view, in order to have a greater stability to the portfolio over a long period of time, debt definitely should be a part of the portfolio.
Okay, and one more question then on behalf of Amit. We've seen, because of the way the equity market has been, there's a lot of interest now in, say, gold or precious metals. Does that find, like a gold ETF find a place in somebody's portfolio now? Yes,
gold ETF can be a part of portfolio, but you need to understand that there are times when gold doesn't deliver enough returns. So can be a tactical play in there if you are able to take a call when the gold prices will actually add value. On a static basis, you can have around 3 to 4% consistently in gold, but not beyond that, because I think gold has a very limited scope of generating returns because there are phases in which gold will do well. There may be prolonged phases when gold may not deliver any returns. So you have to manage that portion a bit more carefully in your portfolio so that there's not a portion of your portfolio which is not generating return at a given point in time.
Okay,
so that needs to be taken care of.
Okay, Amit, does all of this work for you? Do you have any more questions?
No, Smita, I think that helps. Thank you so much.
Okay, Amit, thanks so much for calling in, and all the very best with your portfolio. We'll take a very quick break, come back in a bit. Himanshu stays on with us. Lots more mutual fund queries are lined up next.